Welcome to the Deep Dive. Today we're getting into the latest numbers from J.B. Hunt. They're a huge name in North American transport and logistics, and we've got their Q2 2025 earnings reports, presentations, plus some industry takes from FreightWaves. We're going to quickly break down what these figures tell us about J.B. Hunt and the wider freight scene. Okay, let's jump right in. J.B. Hunt's second quarter results for 2025. What's the main takeaway? How do they look compared to last year?
Yeah, it's interesting. When you look at JB Hunt's overall picture for Q2 2025 versus Q2 2024, the revenue side is actually pretty flat. But profitability, well, that took a little bit of a dip. So their consolidated revenue was $2.93 billion, flat year over year, basically right where analysts expected. Diluted earnings per share, EPS, that came in at $1.31, just a penny shy of last year's $1.32. But the number that really catches your eye is the operating income. That went down 4% compared to last year, landing at $197 million. Although it's worth pointing out, if you take out fuel surcharges, which bounce around a lot, their actual revenue edged up just 1%.
Okay, so revenue holding steady, maybe even up a tiny bit without fuel, but operating income is down. That tells me costs are biting, even if sales are okay.
That's exactly it. When you dig into why operating income dipped, it really comes down to a few key things hitting them across the board. We're talking increases in casualty and group medical claims, so insurance and healthcare costs, higher wages for their professional drivers, and also equipment-related costs. It just highlights these, stubborn inflationary pressures that are still out there in the industry. JB Hunt's big, but they're not immune. That said, their overall operating expenses did dip slightly quarter over quarter by about 40 basis points, 0.4%. So they are trying to clamp down on those costs internally.
Right, a small win on the expense side, but still facing those headwinds. Now, J.B. Hunt has 5 main business lines, right? Let's dive into each one, see what's really going on under the hood.
Absolutely. Let's break down these distinct and complementary businesses, as they call them. First up, Intermodal, or JBI. This is their core, their biggest segment. We're talking 49% of total Q2 revenue and the same 49% of their operating income.
The heart of the company, how did Intermodal do?
Well, revenue is actually up 2%, hitting $1.44 billion. And that was driven by a pretty strong 6% jump in the number of loads they moved. So more volume. But, and this is, the catch operating income fell 4% to $95.7 million. And the reason is, even though they moved more loads overall, the revenue they got per load actually went down by 3%. They said this was mostly because of a mix shift. More of their business moved to their eastern network.
Okay. Shorter routes in the east compared to, say, cross-country.
Exactly. Those eastern loads typically mean shorter distances, so less money per load. And eastern loads surged 15%, while the longer transcontinental ones actually dipped 1%. And on top of that, JBI also got hit by those same higher driver wages, the casualty and medical claims, and higher maintenance costs. They did offset some of it, thankfully, by using their trucks and trailers more efficiently. Okay, next up, Dedicated Contract Services, or DCS. This part of the business brought in 29% of Q2 revenue and a really significant 47% of the operating income.
Right, this is where they provide the whole package, trucks, drivers, everything for specific clients. Similar story to Intermodal.
Very similar, yeah. Revenue was basically flat at $847 million. Operating income slipped just a bit, down 3% to $93.7 million. The flat revenue happened because they had about 3% fewer trucks operating on average, but they managed to squeeze more out of each truck. Productivity, like revenue per truck per week, was up 3%, and if you take out fuel, it was actually up 5%. And their customer retention is still really strong, around 92%. That's, good sign customers are happy. But just like Intermodal, DCS felt the pinch from higher medical and casualty claims, higher driver wages, and those equipment costs. It's definitely a pattern.
Okay, now for Integrated Capacity Solutions, ICS, that's their brokerage arm, right? This part of the market can be pretty wild. How do they do? This was 9% of their revenue.
You got it. And this is where the story gets really interesting and actually surprisingly positive in a way. So ICS revenue did fall 4% to $260 million, and the number of loads they handled dropped 9%. That doesn't sound great initially, but the big news, the really big news, is their operating loss. It shrank dramatically, down to just $3.6 million. Compare that to Q2 last year when they lost $13.3 million. That's a huge improvement.
Wow, okay. From a $13 million loss to under $4 million, what turned that around so much?
It's pretty impressive, right? What happened was their revenue per load actually increased by 6%, and that was mainly because they got better rates on their contracted business and had a better mix of customer freight, even though the general spot market rates were lower. They've clearly shifted focus to more stable, contractual business. That now makes up like 62% of their loads and 63% of their revenue in ICS. And the improved bottom line came from, well, a slight bump in gross profit, about 1%, but also better gross profit margins up to 15.5% from 14.8%. Plus, they cut costs on personnel, cargo insurance, and technology. Oh, and their carrier base, the truckers they work with, grew 8%. Seems like efforts to tackle things like cargo theft might be paying off too. A real strategic tightening there. All right, moving on to final mile services, or FMS. This segment shipped in 7% of revenue in Q2 and about 4% of operating income.
Okay, the last mile stuff, delivering the big bulky things like furniture, appliances. Given how consumer spending's been, I'd guess this one might have struggled.
You'd guess right. Yeah, FMS saw a pretty significant 10% drop in revenue, down to $211 million. And the operating income, it really dropped hard, down 60% to just $8.0 million. The revenue fall basically came down to, well, softness in demand across the board for those kinds of goods. And also they mentioned strategic efforts to improve revenue quality, which sometimes just means letting go of less profitable business.
Right, focusing on better paying deliveries, even if it means fewer total deliveries.
Exactly. But that sharp drop in profit was mainly due to the lower revenue volume, plus, again, those higher casualty and medical claims, and also an increase in bad debt expense, people not paying their bills. And it's worth mentioning Q2 last year had a $1.1 million one-off benefit from some claim settlements, which makes this year's comparison look even worse. And finally, Truckload, or JBT. This is their standard over-the-road truckload segment. It accounted for 6% of revenue and just 2% of operating income.
Okay, the traditional trucking piece, often moving spot freight. How did that segment perform?
Actually, revenue here was up 5%, reaching $177 million. And that was driven by a pretty healthy 13% increase in load volume, so moving more stuff. However, like Intermodal, operating income went down, falling 5% to $3.4 million. So even with more loads, the revenue per load, once you strip out fuel, fell by 4%. They also had fewer trailers available, about 450 fewer effective units, but they managed to turn their trailers around much faster. Trailer turns were up 17%. They put that down to better network balance and focusing on utilization, getting more out of the assets they do have.
But still, the profit dipped. Same reasons again.
Yep. Operating income was hit by, you guessed it, higher casualty and group medical claims and higher maintenance costs. Those cost pressures are just everywhere. So yeah, after going through all those segments, it kind of begs the question, what does all this tell us about J.B. Hunt overall? Their financial strength, how they're holding up, and where they might be headed in this pretty choppy freight market.
Yeah, what really stands out to me is that constant drumbeat of rising costs, the benefits, the driver pay, the insurance. It feels like they're swimming upstream against that.
Exactly. And you see that reflected in their balance sheet, too. Their total debt climbed to about $1.72 billion by the end of June, up from $1.48 billion a year ago. But it's not just about taking on debt. They also bought back a good chunk of their own stock, about 2.4 million shares for $319 million just in this quarter.
Okay, so borrowing more, but also investing in their own shares, that signals some confidence from management, maybe.
That's generally how you read it, yeah. It suggests they think the stock is undervalued despite the tough market conditions.
So for you listening, trying to get a handle on this logistics giant, J.B. Hunt always talks about being competitively differentiated, helped by industry dynamics and positioned for growth.
Huh?
How do these Q2 numbers really stack up against those claims?
Well, you can definitely see arguments for it. The way Intermodal grew loads, even with pricing pressure, and how ICS turned towards profit by focusing on contracts that does back up the competitively differentiated idea. Their huge intermodal network is, a unique asset, especially as shippers look for cost savings and greener options. And the industry dynamics, they mentioned shippers needing reliable service, needing to cut costs, that plays right into their strengths, especially in intermodal and dedicated, which offers stability. And they're clearly pushing their tech platform, JB Hunt 360 degrees, trying to drive efficiency. That's key. But you can't ignore the big drop in final mile or those cost increases hitting every single segment. It shows that even a giant like JB Hunt is really feeling the heat from the economy and competition.
They're managing, definitely, but it's tough out there. Yeah, this deep dive paints a picture of, well, a really complex situation. A resilient company, for sure, but one navigating some serious market swings and those persistent cost headaches.
Absolutely. And it really leaves you wondering, JB Hunt has this big vision, create the most efficient transportation network in North America. Given these mixed results, how are they going to tweak their strategies? How will they innovate and manage costs to tackle these ongoing challenges? And maybe more importantly, what does that mean for the rest of us, for the supply chains we all depend on?